Fueled by growing demand from manufacturing and e-commerce users, the U.S. industrial market continued to strengthen during the final months of 2013. The national availability rate dropped 40 basis points during the quarter to finish 2013 at 11.3%. That's down 22% from its post-recession peak. Nationwide, almost 78 million square feet of space was absorbed, with 48 of the top 51 markets seeing positive net absorption. Nearly 37 million square feet of new industrial space came online during the quarter, capping off the strongest year for new construction since 2009. And the national average asking rent inched up to $5.74 per square foot, its highest level in more than 4 years. E-commerce activity in the United States has continued to accelerate. Online sales grew by 21% during 2013, accounting for 6% of all retail sales. To keep up with consumer demand, e-commerce companies are heavily investing in their supply chain networks, fueling strong demand for big box distribution centers, as well as older infill facilities in major markets. This is especially true in key inland and coastal port markets like Chicago, Dallas, Inland Empire, and Houston, all of which saw strong absorption during the fourth quarter. E-commerce companies are actively competing for the limited supply of modern space, giving landlords in many markets the upper hand in negotiations and prompting some developers to start construction on speculative big box facilities. In 2013, we saw $45.9 billion in industrial sales transactions across the U.S., up 12% from 2012. Warehouse sales volumes were even stronger, up 22% year over year. REITs, pension funds, and other institutional investors accounted for 2/3 of this year's transactions, with the balance going to users. The national average cap rate held steady at 7.5%, as strong demand from investors of institutional assets, especially those located in primary markets, counterbalanced the increase in U.S. Treasury yields. Investors continue to focus on high-yielding secondary and smaller distribution markets, resulting in stronger activity in markets such as Philly, Harrisburg, and Phoenix.
The Dallas market has the fastest growing employment base in the country, as well as a strengthening manufacturing sector. 3 factors underpinning the red-hot growth of the metro's industrial market during the fourth quarter. They are as follows. The Dallas availability rate dropped 130 basis points during the quarter to 10.5%, its lowest level since 2001. Dallas absorbed a nationwide high 7.9 million square feet of space during the fourth quarter, the market's 13th straight quarter of positive absorption, and 4.6 million square feet of new supply came online during the quarter, the metro's highest quarterly amount since 2008. An additional 10 million square feet is currently under construction, 86% of which is pre-committed. Build-to-suit activity has dominated construction activity since 2012, headlined by large-scale developments by Amazon, L'Oreal, and Quaker Distribution. With supply levels tightening, expect to see an increase in speculative construction in the coming months.